Hey guys, it's Dave. So we had an inflation report come out today. The CPI for the month of April came out, and it actually came in right at expectations with a zero point 0.4 increase in the overall price index. And that brought the yearly number to 4.9. So we're still high. We're still at 4.9% as the annual inflation rate, but things are trending in the right direction. Let me kind of show you on the chart. I've shown a previous one of these in videos before. This is what the Bureau of Labor and Statistics releases when they do the CPI. And it's got a pretty handy little graph here that kind of visualizes things pretty easily. What we have done, if you look here, this is this month's 0.4 reading, and it actually cancels out the 0.4 we had in April of last year. So we've lapped this number, and that means that this is the 12 months running that equal the 4.9. If you take these two big ones out, these are our next two months that we have to go up against, comparables, if you will, for May and June. Once we knock those out, you'll see that we've got kind of a decent little lower trend. In fact, these 10 months here, if you add them up and divide by 10, we have been averaging 2.8%, much closer to the 2% goal that the Fed wants us to be at. So this is really encouraging. Obviously, if we come in higher and we don't knock so much off of these two big pillars of inflation, then we could see rate hikes, or we could see a change in the stance or the wording of the Fed. They have basically taken and everybody believes that there's not going to be any rate hikes at the next meeting. Here's kind of a graphical representation of that, where you have the next meeting is June 14th, and so they're expecting zero changes to the rates, and then they're starting to forecast drops, and I've discussed this in a previous video, but these are updated numbers now. And if you want to actually take a look kind of at a different way of looking at this, there is now a 98.5% chance that we keep the funds rate at the 5 to 5.25. That's where we're at right now. And the market is basically predicting that there's a 98.5% chance we have zero movement. But this is where it gets interesting. If you look towards the following month, July 26th meeting, you're actually showing a 44% chance now of a reduction to the 4.75 to 5 range. So that's interesting. You can see here the probabilities of that. The probabilities went from a 29% chance of that to a 44% chance in just a day. So things are really starting to favor, at least the market is starting to favor rate cuts sooner rather than later. We'll see if that happens. Obviously, this is a prediction for the future, but it's interesting to note, if you go back to this one, that the last few trends here are actually a little higher than comfortable. If you average that out, the 0.4, if we average that going over each month, that's a 4.8 annual rate, and that's too high. A 5% is actually a 6.0, which is too high. So we'll have to, we need more of these 0.1s and 0.2s, but so if that's the case, why are people saying we're going to start cutting? And that's because the information in the CPI is lagging. One of the things that you can see is rents. If you look at what people are anticipating, or I'm sorry, what the data is showing that the rent prices are, they're showing that they're going up. Actually, that was back here at 8.8% year over year. And hang on. So right here, we've got an 8.8% year over year for rent on your primary residence. That's the annual read that they're showing year over year. But if you come up and look at, according to rent.com, rents have been falling over the last several months and are actually about flat from a year ago. This is March of 22, this column, and March of 23. They're showing a year over year change of negative 0.4. So the CPI is still kind of counting this rise in rents that we had at the end of 22, and they're not showing that we're actually flat from March to March. Their data comes in late, it's lagging. So that's why people feel like the Fed's going to pause now and kind of see this lagging data come up. They feel like they've done enough to take effect, and that the full impact of these interest rate hikes has yet to really show up in the reports, but it's showing up in real life. Right now, rents are flat a year over year, according to the data that rent.com can pull from all of their listings right now, real time. And the Bureau of Labor and Statistics, being anything with a bureau means it's slow. So their data is completely delayed. So that's why you're seeing this prediction of rate cuts coming into the future. They feel like they've done enough, and there's not much more to do. We'll see what takes effect. So that's kind of exciting to me, because rate cuts means we should start to see mortgage rates come down. It'll be interesting to see how that plays out, because we're still showing the real estate market is really strong. This crash that everybody was anticipating, I mean, we're 3% down on a national average from last year. A 3% is not a crash, man. That is not a crash. And we're still kind of following last year's trend. It's just not as steep as it was. And that's because last year they were forecasting all these rate hikes, and it's kind of like your last chance to get a low mortgage is happening in here. And everybody jumped on and got, into their houses before rates went up. And so we're starting to see, even with high rates, we're seeing the housing prices be pretty resilient. Now, here's the number of listings is still pretty low. So here is, let me get to 2020 in there. You see, we now have more new listings than we did in the pandemic drop, but still well off the 21 and 22 numbers. So, and then the number of homes sold is still pretty low as well, just barely above the low of 2020 in the pandemic. So, housing is holding up. Yes, it's off its lows. Yes, there's certain markets that are not doing so well. Austin, Boise, some of those, but Miami is up. And then overall, as a nation, the median sales price is still doing pretty good. And this is kind of exciting. If we do get rate drops, then who knows? I mean, we still might see a resilient housing market. We might get out of this without a crash. Now, one thing to caution you for that some people are mumbling about is Airbnb. There are quite a few people that are experiencing a low in their bookings for their Airbnbs. It's called an Airbnb bust or an Airbnb bubble. But basically, you had a lot of people try and take advantage of short-term rental market, and then they started experiencing a saturation of that as things normalize, and you don't have that pent-up demand for people to travel. You're starting to get more supply of Airbnbs, and that's putting downward pressure on those numbers. So we could start to see people ditching their short-term rentals and selling them because they're not profitable anymore. You could see a spike in inventory if that happens. So I'll keep watching that very closely. If you want to stay tuned to information like that, or you like this video, please subscribe or like the video and share it if you think it's great. I appreciate you watching. Thanks a lot. See ya.